Most people think building a retirement portfolio means juggling dozens of funds, stocks, and complicated strategies. The truth is far simpler and far calmer. You really only need 4 exchange-traded funds to build a complete, well-rounded retirement portfolio. Just 4. Because a strong portfolio only has to do 4 jobs: grow your money, pay you income, spread your risk worldwide, and stay stable. 1 ETF for each job. And here is the secret the complicated finance world will not tell you. A simple 4-fund portfolio often beats the tangled mess most people end up with. Fewer funds means lower fees, less overlap, less to manage, and far less stress, especially in retirement when simplicity really matters. Quick but important note: this is general education, not financial advice, and the right mix depends on your own situation. Take it as a framework, not a prescription. I will show you the 4 ETFs, what each one does, how to combine them, and how to honestly think about the bold claim in the title. Let us start with why 4 is the magic number. Before the tickers, understand the framework, because the framework is what actually matters. A retirement portfolio needs to do 4 things. Job 1, growth. You need assets that grow your money over the long term so it outpaces inflation and builds real wealth. Job 2, income. You need money that pays you, dividends and interest you can live on without selling everything. Job 3, diversification. You need to spread your risk beyond just one country, so a single market's bad decade does not sink you. Job 4, stability. You need a steadier anchor that cushions the ride and gives you safe money to spend when stocks are down. Cover those 4 jobs well, and you have a complete portfolio. The beauty is that one low-cost ETF can handle each job, which is why 4 is enough. But why stop at 4? Why not 20? It is tempting to think more funds means more diversification. Usually, it just means more overlap and more confusion. Most popular funds hold the same giant companies. Owning 20 of them often means buying the same stocks again and again, with no real extra protection. Meanwhile, just these 4 broad ETFs already hold many thousands of companies across the entire planet. The diversification is already done for you. Piling on more funds also creates analysis paralysis. It gets harder to manage, harder to rebalance, and easier to make emotional mistakes. A simple 4-fund portfolio is cheap, easy to understand, and easy to maintain for 30 years without touching much. Simplicity is a feature, not a weakness. In investing, complexity rarely pays you more. Often it just costs you more in fees and stress. So let us meet the 4. Here is the foundation of the whole portfolio. Number 1, VTI, a total U.S. stock market fund. This is the growth engine of the portfolio. In a single fund, it owns essentially the entire U.S. stock market, large, mid, and small companies across every sector. Thousands of businesses in one click. It is also incredibly cheap, with a fee of roughly 0.03%, so almost nothing is skimmed off your returns. Historically, the broad U.S. market has trended powerfully upward over the long run, which is exactly why it anchors the growth side of your portfolio. Its job is simple but vital: to grow your wealth over decades. For most long-term investors, this is the core holding everything else supports. Remember, growth comes with volatility. This part will swing hard in a crash, which is exactly why the next 3 holdings exist to balance it. The second ETF turns your portfolio into a paycheck. Number 2, SCHD, a U.S. dividend equity fund. This is the income layer, and it is a retiree favorite. It focuses on established, profitable companies with strong track records of paying and growing their dividends, quality businesses that share their profits. Instead of only hoping prices rise, you get paid regular dividends just for holding it, income that can grow over time and that you can live on in retirement. These dividend payers also tend to be a bit steadier than the broad market in rough times, adding both income and a little extra resilience. And it stays low cost, with a fee of roughly 0.06%, so it does its job without quietly eating your income. One honest note: dividends can be cut and dividend funds can still fall in a crash. This is income with quality, not a risk-free paycheck. The third ETF takes your portfolio global. Number 3, VXUS, a total international stock fund. This is your global diversification in a single holding. It owns thousands of companies outside the US, across both developed and emerging markets, household names, and fast-growing economies around the world. Here is why it matters. The US will not always be the world's best-performing market. Different countries lead in different decades, and you want to own the winners wherever they are. When the US has a weak stretch, international holdings can pick up the slack, smoothing your overall ride and reducing your dependence on one country. A common guideline is to hold somewhere around 20 to 40% of your stocks internationally, though that is a starting point, not a hard rule. You are not predicting which country wins. You are simply refusing to bet everything on one. That is what real diversification looks like. The fourth ETF is the calm anchor that holds it all together. Number 4, BND, a total US bond market fund. This is the stabilizer, the calm anchor of the portfolio. It holds thousands of investment-grade bonds, from government to high-quality corporate debt, lending money out in exchange for steady interest. Its main job is stability. When stocks crash, bonds usually hold far steadier, cushioning your portfolio and giving you safer money to spend. It also pays regular interest, adding another stream of income on top of your dividends, which is especially valuable once you are living off the portfolio. And it is your main tool for getting safer as you age. As retirement nears, you typically hold more in bonds so a crash can do less damage. Bonds are steadier, not risk-free. They can fall too, especially when interest rates rise. But they remain the classic counterweight to stocks. So how do these four actually work as a team? Separately, they are just funds. Together they form a complete machine where each one covers a job the others cannot. VTI drives growth, SCHD pays income, VXUS spreads you across the world, and BND steadies the whole thing. 4 jobs, 4 tools, no gaps. When the US stumbles, international can hold up. When stocks fall, bonds and dividends keep paying. Something is almost always working for you. The result is a smoother journey. You give up a little of the wildest highs in exchange for far fewer gut-wrenching lows, which is exactly what retirement needs. And because all 4 are low-cost index-style funds, your total fees stay tiny, so compounding works for you instead of being eaten alive. That is the magic. A complete, globally diversified, income-producing, growth-oriented portfolio, built from just 4 holdings you can actually understand. But how much should you hold of each one? Here are 3 example mixes for different life stages. These are illustrations to show the idea, not personalized recommendations for you. Decades from retirement, you can tilt toward growth. For example, a large slice in VTI, smaller slices in SCHD and VXUS, and just a little in BND. As retirement nears, you might dial down risk, trimming the growth slice and growing your bonds and dividend holdings to protect what you have built. In retirement, many shift further toward income and stability, holding more in SCHD and BND so the portfolio pays them and holds steady through crashes. The right split is deeply personal. Your age, your savings, your risk tolerance, and other income like a pension or Social Security all change the answer. So please do not copy these percentages blindly. They are here to show the pattern, get safer and more income focused as you age, not to tell you your exact numbers. Once you pick a mix, one simple habit keeps it healthy. Over time, your winners grow and your mix drifts away from your target. Rebalancing simply returns it to plan, usually about once a year. Say stocks have a great year and balloon to a much bigger slice than you wanted. Your portfolio is now riskier than you planned, without you noticing. Rebalancing means trimming what has grown too large and topping up what has shrunk, bringing every holding back to its target percentage. The quiet genius is that it forces you to sell a little of what is expensive and buy what is cheap, automatically, without emotion or guesswork. Most importantly, it keeps your risk where you want it, so a long bull run does not secretly leave you overexposed right before a crash. Pick a date once a year, rebalance back to your target, and otherwise leave it alone. Boring, mechanical, and remarkably powerful. Now, how does this 4-fund portfolio actually pay you in retirement? In retirement, this portfolio pays you in 3 quiet ways that work together. First, the dividends from your stock funds and the interest from your bonds arrive automatically, a stream of cash without selling anything. Second, when you need more, you sell small slices of the portfolio in a controlled way, ideally from whatever is up, not down. A commonly cited starting point is withdrawing around 4% of your portfolio in the first year, then adjusting. But that is a rough guideline, not a guarantee your money will last. Third, because you hold bonds and income, you can spend from the steady side during a crash and leave your stocks alone to recover. That protection is the whole point. Safe withdrawal rates depend on your timeline, the markets, and your spending. This is exactly the kind of number worth planning carefully, ideally with a professional. 2 more things make this portfolio quietly powerful. 2 often ignored factors can make or break a portfolio over decades: fees and taxes. The good news is this setup handles both well. All 4 ETFs are extremely low cost, so you keep almost everything the market gives you, year after year. Over 30 years, that difference is enormous. Where possible, holding these inside tax-advantaged retirement accounts lets your growth and income compound with far less drag from taxes. Some investors also place their bond and high-income funds inside sheltered accounts, and keep the most tax-friendly funds in regular accounts, to be efficient. It sounds minor, but a percent here and a percent there compounds into hundreds of thousands of dollars over a long investing life. Tax rules differ by country and situation and they change, so this is general education only. A qualified tax or financial professional can tailor it to you. Now for the most important part, the honest truth behind that title. Let me be completely honest about the bold claim: the only portfolio you will ever need. No single portfolio is genuinely the only one anyone will ever need. That is a catchy phrase, not a financial law. Different people need genuinely different things. What is true is that these 4 ETFs are a strong, simple framework that covers the core jobs of a portfolio. For many people, it is more than enough. But it still needs to fit you. Every one of these funds can lose value, especially in the short term. Past performance does not guarantee future results, and even a great portfolio has painful years. Your age, goals, health, country, taxes, and other income sources all change what is right for you. A real plan accounts for all of it, not just 4 tickers. And the big one: I am not a financial advisor and this is not financial advice. These are not by recommendations. It is education to help you understand the building blocks. Before you build or change a real retirement portfolio, do your own research and consider a qualified, fee-only fiduciary who must act in your interest. The real lesson is this: a simple portfolio you understand and stick with beats a complicated one you abandon in a panic. That is the actual edge. So here is the entire 4 ETF retirement portfolio, in one place. VTI, the total U.S. market, your growth engine. SCHD, U.S. dividend stocks, your income and quality layer. VXUS, total international, your global diversification. And BND, total bonds, your stabilizer and anchor. Choose a mix that fits your age, automate your investing, rebalance once a year, and gradually get safer as retirement approaches. 4 holdings. 4 jobs. Growth, income, global reach, and stability, all covered without the overwhelm. It is not flashy, and that is exactly why it works. Boring, low cost, and diversified is how quiet fortunes are actually built. If you take one thing from this, let it be this: you do not need a complicated portfolio to retire well. You need a simple one you will actually stick with. These 4 building blocks, held patiently for years and decades, can quietly grow into a calm and secure retirement, through every crash along the way. And you do not need to be wealthy to start. You can begin with small, automatic amounts at any income, and let time do the heavy lifting. As always, understand the basics first: how risk, fees, diversification, and compounding really work, before you commit real money. To begin, open a low-cost brokerage or retirement account, which takes only minutes. Then choose your mix of the four: set up automatic investing, turn on dividend reinvestment, and let it run. You do not have to perfect it today. Start simple this week, and refine as you learn. Beginning beats waiting, every single time. If this made retirement investing feel simpler, you know what to do. Keep building, and I will see you in the next one.